Nice to see everyone. Thank you guys for joining. Just for those of you who haven't met me yet, I'm Morgan Krupetsky. I run institutional business development at Avalabs. Avalabs' mission has always been to digitize and tokenize the world's assets. And so we've been doing a lot of work in the asset tokenization space, really looking at and working with projects that are tokenizing really like anything and everything as it relates to different types of off-chain assets. Everything from cash and cash equivalents, treasuries, money market funds, to alternative assets in the private equity, credit, real estate, infrastructure space, and then things like art, whiskey, and wine, and kind of everything in between. And what we realized in kind of having these conversations is, people talk a lot about like the Web3 world being like a rabbit hole, and within the tokenization space, I feel like we're literally in like a rabbit hole of rabbit holes, and oftentimes we kind of forget to take a step back and talk about the space and give the space and the opportunity for our peers and individuals as well as institutions to ask kind of what they might deem as basic questions, but that really aren't that at all. And so we wanted to use this space to really kind of feature different Avalanche ecosystem partners that are in some way, shape, or form touching or building within the tokenization space, and really use it as like an informal forum and discussion to educate ourselves, to educate our community, to foster greater dialogue and participation. And so that really was kind of the genesis for the Money Move series. And as Kyle mentioned, again, can't believe that this is already our sixth installment. And here today, and Kyle, you can maybe kick it off, but we're featuring three different partners, and I'll let you guys introduce yourselves. We're featuring three different partners who are, in the first instance, focused on tokenizing money market funds, T-bills, commercial paper, what we would call kind of short duration credit products. There's many out there in the space that are focused on this, and we'll kind of go into why that might be the case and what are the benefits and the different utilities associated with it. But that is, that's kind of the overall genesis of the series as well as of the discussion today. Kyle, do you know if we've gotten the Franklin Templeton?
No, we haven't, but I'm gonna try to do a re-invite here. But yeah, I think we should just kind of
Okay,
kick off and
sure.
have Scott and Dave. I think Dave actually just dropped on accident as well, but
Dave heard my intro and he's like, I don't want to talk about this anymore.
rug game for sure.
I actually see he's
There
back.
we go.
So
Yep,
I think Dave, can you hear us?
it's loading up. It takes like a second to load a speaker, but I think
Okay.
in the interim, what we'll do is Dave. Hey, welcome back. Thanks for popping back on.
Yeah, sorry, had some connectivity issues. I'm back. It wasn't you, Morgan.
Yeah, yeah.
Should we
Yeah, go ahead and
do you
let's do a quick round of intros. So yeah, as Morgan was saying, we'd love to hear from both of you, and then we'll get Roger up here as well. And Dave, we'll just kick it over to you. Can you give us a quick intro on kind of like what you do with Opentrade and kind of your role in kind of this space and what you're looking to build?
Yeah, of course. Nice to meet all of you. I'm Dave Sutter. I'm CEO and co-founder of Opentrade, which is an institutional grade platform for lending and yield products backed by liquid assets, including the topic of today, U.S. Treasury bills. And I'm based in London, and but originally from the States.
Awesome. Thanks for the quick intro. And Scott, why don't we kick it over to you?
Sure, yeah. Thanks for having me. So this is Scott Smiley, co-founder and CEO of HighYield. Been working in the blockchain crypto space going on 6 years now. And before that, I was working in traditional finance and investment banking at Deutsche Bank. So now I'm working at HighYield, which is kind of a convergence of my backgrounds and passions. We're building infrastructure for on-chain capital markets, starting with high yield offerings in the high yield lending market, offerings being fixed duration fixed income products, and the lending market being, kind of like an on-chain repo facility, like borrowing and lending against these offerings as collateral.
I'm very excited to break down all of those words that you said.
A lot of trying to squeeze as much words
Me
out
too.
A lot of
as I could.
jargon. We're gonna crack through.
We're gonna crack through that.
Totally, I'm excited. And then Luke, I see that you're up as well. If you want to introduce yourself.
Yeah, sure. Good to be with all you guys. I'm Luke. I'm on the institutional BD team here at Avalabs with Morgan. Been on the team for pretty much all of 2023 at this point. Prior to joining, I was at Maple. Prior to that, was at Falcon X. So a couple stops on sort of the institutional side of the crypto space, and kind of have been thinking about real world assets, off-chain assets, whatever you like to call them, for the past couple of years, and get to do that every day here at Ava, and in the Avalanche ecosystem. So work with projects like HighYield and like Opentrade to ensure that they are as successful as possible on Avalanche.
Cool. Thanks very much. So at some point we'll get Franklin Templeton to join. I was very excited to have them as well. This is going to be their first Twitter Spaces.
He's coming on. He just had to fix his device, so I connected.
I think at some point Twitter has to be able to allow you to join via your desktop. Like
it actually does. It's just like it's not open to everyone, and it's really glitchy. So it's like not a great experience. But I actually have done it once before, so we'll see. They got a lot of things to fix. Go ahead, Maury.
So while they come up, I'm happy to kind of dive in. I think, and again, just Scott, to your point, really trying to take a step back and distill a lot of the concepts. You mentioned repo, we mentioned long and short duration. Want to be able to kind of break down what all these kind of terms mean. These terms are very, I would say, loosely thrown around in the real world asset / tokenization space, but really want to take this time to kind of distill some of those things. So between Opentrade, HighYield, and Franklin Templeton, all of these companies and protocols are focused on tokenizing different types of assets, and in the first instance, really focusing on more shorter term U.S. money market funds, T-bills, those types of products that are kind of safer, I would say, from a credit risk perspective in a variety of different ways, in terms of how they've been referred to historically. So maybe I'll open it up either to you, Scott, or Dave, if you want to kind of just talk us through, like, what are money market funds? What are T-bills? And why are they so, how are they adopted today in TradFi, both by retail as well as institutions? Like, why are they so important to the financial system as we know it today? And then we'll talk about why it's important to bring them on chain, but maybe just to level set, would love to kind of hear your guys' take on that.
Yeah, I'm happy to kick it off and then let Scott chime in. So so let's first talk about treasury bills, which are a key asset in a money market fund. A treasury bill is a type of security, a debt security issued by the United States Department of Treasury that, quite frankly, they use to fund themselves. So there's a lot of things we'll talk about that they do, and they serve as the bedrock for the capital markets. But in the most basic form, the United States government, when it spends more than it earns, it doesn't print money, it issues treasuries. And it issues several different durations of treasuries. Treasury bills, which are debt securities with maturities of less than a year. It issues treasury notes, which are debt securities with maturities between 2 and 10 years. And it issues treasury bonds, which are debt securities with maturities of 20 and 30 years. And they all have a different role to play in the financial system. But put quite simply, they are used by the Fed to control monetary policy. They buy and sell and lend against treasury securities to control money supply in the economy. Foreign governments, central banks hold them as a key reserve asset, so they can prop up their own foreign currencies. and have access to dollars to trade. Our banks buy and hold them as part of their tier one capital and reserve requirements to meet regulatory requirements. And they're a core asset in our money markets. So in repo and reverse repo, which are cash-like instruments involving borrowing and lending against U.S. Treasury securities. So they're very, very important. They touch pretty much every aspect and influence every aspect, even of our daily lives, without realizing it.
Yeah, no, that's definitely a fair overview of Treasury bonds and bills and notes. I feel like from, like a crypto native's perspective, one thing that is like so different, I think, between TradFi and DeFi for the most part from what most people probably listening here are experienced with it or had experience with is depositing in Aave or Compound. Like it's just this ongoing loan that continues to accrue interest. There's like no term, but like everything that we just mentioned here, T-bills, treasury notes, treasury bonds, like that's like the traditional debt markets, debt capital markets all have some kind of fixed term. And the way that retail is used to dealing with these things is more like Aave and Compound, where you just deposit money in a bank. And most people think of their money that they have in the bank as, actual cash, but really it's very similar to like a deposit token in Aave or Compound, where the money is being used to purchase these fixed duration assets. And by fixed duration, it means like you don't get your principal back until maturity. You don't get like your money back until it matures for the most part, just to keep it simple. I don't know. That was a huge question you asked there, Morgan, with a lot of potential angles to go.
You know what?
So,
It's so
Yeah.
funny. Like sometimes the most basic questions are, I mean, they shouldn't be difficult to answer, but sometimes you just like don't think about like answering them for so long because you just like assume, or you just like assume everyone's on the same page. And so I always like to like kind of level set in the beginning. And I think just to add maybe something to what you guys were saying is, generally it's when we consider these kind of products in the U.S., they're U.S. Money market funds, T-bills, notes, and bonds, and they're considered, again, I think I mentioned this earlier, safer, quote unquote, than other assets because generally they're backed by the U.S. Treasury. And so when people think about like a quote unquote traditional portfolio mix, they think about like different allocations based on an investor's risk return profile, as well as like their risk appetite overall, and how they or their financial advisor, based on their different kind of profile, how they should optimally kind of allocate to different types of assets that are different maturity as well as different risk profile. And so generally speaking, like cash and cash equivalents are known to be as safer than, let's say, equities, private equity, or other types of credit, corporate bonds, and other types of exposures. So that's the only thing that I would just kind of add to that. So I guess given that kind of level set, would love to kind of get an understanding from you both, and Luke, feel free to chime in as well. We're seeing like more and more companies, both startups in the space as well as big asset managers, issuing on-chain T-bills and money market funds. I mean, everyone from Franklin Templeton to both of you guys, I mean, there's a whole list out there, including the likes of Ondo and Open Eden, and more coming out every day, issuing these types of products. So would love to kind of get a sense from you guys. What do you think are some of the primary motivations behind the idea of focusing on this product in the first instance? Within the Web3 world, what do you think is the importance of that? And then we can go from there.
sure. Yeah, I'll jump in and take that one. I'll start. I feel like the bringing on chain like treasuries and such, like these short duration super safe products right now, is less about creating efficiencies in the traditional financial market. In fact, I would say that has like nearly nothing to do with it, maybe to show proof of concepts and such. But and maybe for settlement, I would say is another potential improvement. But what I think people are doing right now and why there's such like a huge drive to do this is more about closing the interest rate gap. Like if you can lend money to the US government that is globally renowned as the risk-free rate at almost 5.5%, like why in the world would you lend on Aave, Compound, Maker, these other protocols at sub 5% at a lower rate? Like you're taking so much more risk for less return, just like doesn't make sense. So like now bringing these assets on chain adds like higher quality, higher yielding collateral types for these existing primitives and existing on chain investors. So I think that's kind of like phase one. But to really get those efficiency, like bring blockchain as a technology to add more efficiencies to existing capital market infrastructure, like if we're going to be doing treasury bills, we need to get the US government behind like issuing them natively on chain, which is a far ways away. So I think like the next phase is really working with smaller issuers to do their debt offerings and do their just security token offerings, to go back to 2018 for a quick second, on chain, to leverage like the faster settlement, the more composability and better financial infrastructure as like a next phase. But right now what's happening is really more about closing the yield gap, in my view.
Yeah, that's definitely great perspective. I see a few others over at Opentrade, primarily being driven by two things. One is access, and I'll explain that shortly, and two is composability. So first, with access, my co-founder and I, Jeff, who's actually listening in here, we used to work at a Center, which was the former governor of USDC. And working there, we saw firsthand the expansion of stablecoins across really the emerging markets. And these companies and individuals were using stablecoins not because they cared about crypto, it's because they wanted digital dollars and digital euros to escape, volatility and price inflation and capital controls. And so what we've seen is a huge growth in the stablecoin economy and continuing to grow, actually, with real world businesses and real world people. And so at Opentrade, we see a huge opportunity and are currently working with a number of businesses and customers in those markets, really to leverage USDC and then treasury bill backed products on chain to get them yield on that USDC. And so that for us is an access issue, right? They don't care what the technology is. They want safe and compliant yields backed by liquid assets like treasury bills denominated in dollars. And then the second, I think, huge opportunity we see is composability. So despite how liquid a lot of the capital markets are today, there's big restrictions on the things that you can do with the products and assets that you hold, because it's really hard to move them across different products and different institutions and different systems. And so I think that bringing things like US Treasury bills on chain is a natural first step for bringing Wall Street on chain, because as a treasury bill or a money market in the traditional financial markets, they serve as the bedrock form of collateral for many, many different products built on top of them. And to do that on chain, the first step is to bring those products on chain so that they can be used across many, many different markets in the digital asset space. And so those are really the two big driving factors that we've seen at Opentrade with bringing this stuff on chain.
Cool. Thanks, guys. Roger, can you hear
I
us?
sure can. Thanks for inviting us to participate in this. And it's a really fascinating conversation. And I concur and agree with the path that we're talking about. I'd like to level set one thing specifically, and that is, a money market fund is actually a portfolio, a fully collateralized portfolio of T-bills. So it's really kind of a derivative of T-bills. It's a T-bills would be the base case. As we're talking about, the U.S. government finances other operations by literally auctioning off T-bills multiple times a week in some construct. Those then are used in a collateralized pool, which is known as a money fund. And money funds, have, quite frankly, have been around for multiple decades now, and they've iterated over a number of different cycles over the past, 70 some years. But the confidence that financial market participants have in money funds means that all over planet Earth, there are literally trillions and trillions and trillions of dollars in money funds themselves that are used not only just by individual users, but actually by institutions as part of their liquidity layer, coming alongside what assets they may hold in traditional bank accounts. They like to use money funds because they are a fully segregated, collateralized pool, not subject to the various operational leverage and or financial leverage that a bank might have in another, with your own kind of counterparty credit risk that a bank might offer inside that. So they complement, they compete, and they offer just an additional opportunity for institutions. And I think as we look forward and we see blockchain technology interlaying itself, as we're pointing out, into the issuance of a number of different securities, whether they be debt instruments issued by the U.S. government or by corporations, or they're more of an equity type of issuance and ownership. That infrastructure of blockchain is allowing for a wider proliferation of what are fairly commonly used plain vanilla tools like money funds that help solve problems for investors large and small.
Thanks for that. That was really good level set, and I'm glad we took the time to do that. Maybe building a little bit more on that and something that you mentioned, Dave. We started talking about the idea of utility, and to what you were saying earlier, obviously the first step is bringing these assets on chain before we can attribute greater and greater utility and composability and really integration with DeFi. But as we kind of look ahead in terms of what are the possibilities, oftentimes I think we'll find it's not necessarily a technological challenge. Sometimes it's more of a regulatory challenge, just depending on, jurisdiction by jurisdiction and different regulators. But would love to kind of hear your guys' take around some of the types of utility that either you are working on actively right now that you think that ultimately this space could realize, and kind of what is the implication for broader adoption on chain, not just by individuals, but also by different types of institutions. So open that up to all of you guys. Not sure who wants to get started, but would love to kind of hear about, what are the types of utility that we could hope to see?
Maybe I'll start. This is Roger.
Yeah.
Our project Benji, which is our tokenized U.S. government money fund, that project has been ongoing for a couple of years, working pretty close collaboration in the United States with the Securities and Exchange Commission to unleash some of the additional utilities that blockchain development system wrapping around this public security kind of brings it up to a modernization place. We have just known for decades now that money funds themselves, away from just T-bills, but money funds themselves have been in the transactional economy. There's been check writing and debit card capabilities on top of money funds for literally decades. So this idea that money funds could possibly be used in the transactional economy in new ways, riding on newer and faster rails, I think is a possibility and an increase. I also think the reason that there's a lot of incentive for this to come together is because during that path of conversation with the SEC, it became obvious as a stakeholder, the regulator as a stakeholder, with the utilization of public blockchains as part of the operations of shareholder activity in a money fund. All of a sudden, the regulator, as a stakeholder in the overall project, not just the shareholders of the money fund or the investment management company that's offering the money fund, but the regulator themselves as a stakeholder, they now have ultimate transparency into what is happening with the money fund. And that's a huge added utility that has not existed heretofore. And oftentimes we don't think of the regulator as a stakeholder, But given the trillions of dollars we're talking about inside of this construct, they absolutely are a stakeholder. And the utility of the public blockchain increases their possibilities as well.
Yeah, that's a really great point. We spent my co-founder and I better part of a decade working on blockchain-based systems for large financial institutions. So I just want to echo what you've said, which is that there's a lot of room for improvement in the plumbing, and the regulators do see the benefit of that type of transparency, to be sure. And I think on top of that, new internet native infrastructure, entirely new products and use cases can surface both for retail and institutional customers. With regards to sort of our view on utility, our objective as a company is to leverage digital dollars and digital euros and in the sort of the wave and the growth of stablecoins and internet native money, to be able to provide anyone anywhere a safe and compliant way to earn yield on their balances, and for companies that provide G7 currency balances on behalf of their customers, fintechs, exchanges, digital wallets, money transmitters, a way to safely and securely transmit yield sourced from liquid investment grade assets, which today are held off chain and with regulated custodians and segregated accounts, but to find a safe and transparent, efficient way to transmit that yield down to the businesses and consumers, especially in the markets where they don't have access to do that today, and to leverage the technology to make that as easy of an onboarding experience for those companies and for those individuals as possible. So I think we see a huge amount of utility value in that, where it's not just a crypto product for crypto captive capital. It's a product for regular businesses and people that they don't have today. And I think that a lot of it does hinge on regulatory clarity, especially when it comes to stable coins. I think on-chain assets, I don't, security tokens and the like, especially in the UK where we're based, there's not too much confusion over them. I think a lot more of the confusion resides around, truly decentralized networks and DeFi and natively issued tokens. But I think on the stablecoin piece, getting regulatory clarity on that is going to unlock a huge wave of institutional adoption. And right behind that is going to be a huge wave of demand for yield on those stablecoins in a safe and compliant manner. And I think the utility value there is extreme. I think it can provide access to entire swaths of the economies outside of the US that really struggle with that access today. And I know Jeremy from Circle talks about it a lot, about the dollarization of the world through internet native dollars like USDC. And I think yield products built on that wave are a natural and very important next step with regards to their utility value.
Yeah, definitely would echo what Dave's saying here about the regulatory environment. Like, I think when people talk about lack of regulatory clarity, they're talking about stable coins and they're talking about, what is ETH, what is SOL, what is AVAX, or these different tokens. Like some would say they're all securities, others consider commodities. Like, that's the lack of regulatory clarity. When it comes to issuing a security, that is pretty straightforward and that has a lot of clarity in the US. I think what will really help grow this space quite a bit, like a catalyst I'm waiting for in the US at least, or excited for, and want to be well positioned when this comes to fruition, is regulators recognizing transactions on a public blockchain as like legally binding. Because right now, like a lot of these issuances, when you're issuing treasury bill on chain, even if you're issuing debt natively on chain, like it's not some kind of wrapped asset, but you're just natively issuing a bond on chain, you still need to go through all of the old hoops. You still need a team of lawyers to review the PPM, right? The private placement memorandum. If it's going to be a private placement, you still need to manually file all these things with the SEC and know the processes. So the kind of mirroring like all of the blockchain-based transactions and trying to make them compliant and registered the old-fashioned way, like needing to mirror that is annoying, and it kind of slows down the industry, but I do think that'll be that'll be a big catalyst to this sector that we've been talking about once there's more legal recognition of what's happening on chain.
Can I ask you guys, and let's like dig a little deeper in terms of, because this topic comes up a lot in terms of like why someone would want to access this product on chain versus off chain. And a lot of times, I hear, and it's similar to what you mentioned, Dave, in terms of giving individuals and companies who don't have ready access to these products in the traditional or Web 2 world, however you want to reference it, but giving them the opportunity to have access on chain. Can you guys just talk a little bit about like, why is it that the on-chain version or UI or UX, like what about it is that thing that enables them to have access versus, off-chain?
Well, this is Roger again. I think in its current construct at Franklin Templeton, the way we think of it is more about the future possibilities that sitting inside of a digital wallet and linking seamlessly, and has been pointed out, some level of composability across a variety of the assets that you might have in a portfolio. If you're thinking about it in terms of kind of an asset allocation, if you're thinking about it in terms of a liquidity mechanism, for long periods of time, you've had to transact, in and out of fiat, or in the new construct, in and out of the stable coin regime. But stable coins grew up in this low interest rate environment, and now I think the possibilities of having an additional stable net asset value product that offers yield are all possibilities. I mean, these are possibilities that are unfolding as this ecosystem is developing rapidly around us. I mean, literally, it feels like 2023. The theme has been real world assets, tokenizing real world assets, and tokenizing treasury bills or the collateral that goes into a money fund, or tokenizing the money fund itself, is all about that real world asset theme and unlocking the possibilities that are going to be coming forward once you're in that environment.
Yeah, we completely agree with Roger there. I think like if I had to pick one thing that makes it better right now, like today, I think instant settlement definitely has a place that's adding like genuine efficiencies, so long as it's not completely reliant on settling in USD like in a bank account, because obviously you still then need to wait for the USDC to be converted to dollars, and then the dollars to settle in your bank account. And then something Dave mentioned earlier about access in other markets, I do think that's or people who don't have access to it traditionally for whatever reason, whether it's just lack of infrastructure or whatnot, like some of that can't be overcome, like you were saying, Morgan, when it comes to like the regulatory hurdle and like capital controls. Like if everybody could just dump their own country's currency and buy as many dollars as they want, a lot of countries would be struggling right now as people race to hold dollars and lend to the treasury. So there are capital controls that don't really can't really be overcome. But sometimes it's not capital controls, and sometimes it's just accessibility, and you need to go through KYC or be onboarded to an American bank might be difficult if you're based in somewhere else like an emerging economy.
Yeah, I'll just to piggyback on that, I'll give you a very tangible example. So I recently signed up for let's call it next generation money market provider. It was not Franklin Templeton, I will say that, but I won't mention.
I was going to say, was it Franklin Templeton?
No, it was not. No, it was not. So my KYC took 3 weeks. I then had to link my bank account by doing penny tests. That took another 3 days. I then had to send an ACH. That took another 2 days. It was over the weekend. So by the time I got my money in, it took 8 days, right after 3 weeks of KYC. I'm now in. Going out the other way takes just as long. That's me, right? An American passport holder of means with an address in the most advanced Western democracy in the world. I think a better question to ask of those in Latin America, businesses and individuals, and Asia Pacific, and many of those economies, is who does have access to those types of investment opportunities and the ability to hold digital dollars. Like, it's not who doesn't, it's who does. And so stable coins allow people to open up the US dollar stores of value at the speed of the internet, right? And then use those stable coins via companies like HighYield, like Opentrade, hopefully one day like Franklin Templeton through its partners or what have you, to then start investing those digital dollars in safe, compliant, liquid investment opportunities. And I think that's always bad. You can see from my Twitter handle, which I haven't changed since 2014, got into Bitcoin when there was only Bitcoin. And that's always been sort of the core mission of decentralized systems like Bitcoin and all of its derivatives. And I think, just Scott's point about capital controls. We've been asked this by buyer investors and others, in due diligence. What would you do if your customers were under those types of sanctions and wanted to operate out of compliance? We would let them. I think the IMF, the United States, all major sort of institutions stand on the right side of history and saying, the movement and the freedom of capital is a very important human right. And so the dollarization of those economies where their currencies are just printing away their savings, and they're the price of a loaf of bread is constant. Like, I think that's a very important thing. And crypto, its permissionless nature, allows them to evade those unjust sort of regulations. And I'll be the one to say it right then and there. That is a use case for these types of products, is to get access to the people that don't, for whatever reason they have today. And I think that's a really important thing.
Maybe I'll weigh in on the other side of that just for a second. Anything that's related to a securities transaction, whether you're distributing treasury bills, notes, or bonds, or in this case, if you're talking about money funds are indeed public securities, wherever they may be domiciled in the U.S. or not. Anybody who's coming into those constructs will have to go through a KYC AML process. And that is just the way the capital markets are organized, in order to kind of keep the what has been the kind of a well-oiled machine working. It doesn't always work exactly as we want it to work, but I just want to make mention that yes, for to be able to utilize these sort of type of technologies inside of the TradFi marketplace, Franklin Templeton does go through a process of KYC AMLing. Our journey, we're not a direct-to-consumer company, proving to the SEC that we could do KYC AML in an environment that is a much faster pace of time than what has previously been experienced. I would encourage you just to, go to the App Store, download Benji Invest, and see how fast that can happen for you, wherever it might be. But as far as getting to places where these products and services haven't necessarily reached before, one of the findings that we have had, due to the operational efficiencies of using a public blockchain for the transaction records for Benji, means that there is a lower cost that we expect could be scaled into from this, that would allow lower minimums for investment products to come about. For example, with Benji, you need to have a minimum of $20 to invest in a mutual fund account. That is creating more operational and accessibility to investors in that, whose services have wrapped around a money fund might be far more expensive, and the minimums might be much higher.
I think that's a really important point, and I'll just add, we do KYC. We absolutely support combating money laundering and the financing of terrorism. And I think you said the most important thing, which was it can be better, right? So it can be done. You can be compliant and do KYC and the things you need to do in a much better way than a lot of the the services that are being offered out there today. And I would say, we've seen, if for anyone that's looking, that bringing these systems on chain helps fight money laundering. they're terrible systems for laundering money. They're very transparent. That I think that's one of the biggest sort of red herrings that some of the regulators in the U.S. have said, is that these are enablers of financial crimes. I think, when compared to sort of traditional systems, that they're a drop in the bucket, and that they're actually far more transparent and would help regulators, to the point you made earlier, actually trace the funds of flows and see who holds these assets and monitor who holds these assets. So definitely not advocating for a totally lawless, permissionless system. We don't do that. I just think that you can use the technology to do it a lot better, and then be more transparent and help regulators fight financial crimes in a better way.
Yeah, I think some of what you guys were mentioning were, I mean, to the extent that all of these products that we're talking about are securities. I mean, I think all companies are not trying to obfuscate laws, rules, and regulations that are clearly out there in terms of what dictates public securities. But I do think, and I think, Scott, you brought up this point in terms of bringing greater dollar and non-dollar cash on chain, whether that's stable coins, tokenized deposits. I know CBDCs are controversial, but to the extent we can bring on, more options from a dollar and non-dollar perspective to enable those, particularly in the broader G10 and emerging markets, to more easily and freely convert those currencies into forms of payment that might be either less volatile than their home currency, and or give them therefore that like easier access point to money market funds. That's something that I know is happening in parallel, and something that I like from an Avalanche perspective, we're very focused on in terms of kind of cultivating a robust FX market on chain to then, be able to more readily access some of the products that you guys are offering.
Yeah, no, definitely want to see like on-chain FX, and the more products and the more transactions that are happening on-chain that are closer to the end consumer or end borrower, the more we'll be able to build composable, transparent financial products.
Yeah, and I think on-chain identity, I mean, we haven't touched on it yet, but that's a huge piece of this sort of, not on-chain identity, let's call it digital identity, portable identity. Doesn't need to be on-chain. That's a huge piece of this puzzle. Imagine if I'm a Benji customer, and this is just theoretical, I'm a Benji customer in Franklin Templeton with the full weight of a multi-trillion-dollar financial institution has done KYC on me. Can I take, my identity, my proof that, someone with standing has verified me? Can I take that and use it to get access to another application? And can I do that in a composable way? I think that's a huge piece of this puzzle that it's a whole nother can of worms I don't necessarily want to open up, but
Totally.
When you talk about expanding access, a portable. Go ahead. Sorry.
I was just going to say, I wonder if Franklin Templeton would want to be the risk taker there, where one terrorist squeaks through and then the whole financial system just points their finger at Roger over here.
Honestly, that's something that like I've been trying to kind of wrap my brain around myself as I've been in this space, because the last job that I had before entering the space was I was chief of staff for a big bank's chief compliance officer. And it's really tough. It's not a technological issue. It's just from a regulatory perspective, how do we provide a more seamless onboarding and KYC experience for individuals and institutions in a way that they can not have to do the same process 50 different times. Like, I would love for you to be able to like KYC once with one bank and then use that credential across all your banks. I don't think that is possible today, but that would be awesome if you could facilitate that. But that might also require some kind of evolution in the regulatory environment as well.
Yeah, I mean, I think it definitely would. And, my co-founder and I, Jeff, we also used to work on Verity, which was a standard from the Coinbase Circle Consortium about, verifiable credentials, basically creating this portable KYC. The regulators were open to it. You're right. It does take, quite a bit of a lift, but they weren't saying no. Right. And I know that there's still a lot of initiatives going on in that space. And I think, yeah, Scott, to your point, Franklin Templeton won't want to be the one issuing that credential, maybe if the environment is the way it is.
Right.
But Yeah, I'll say it right now. I mean, let's make this space a little interesting. The way we do AML KYC today is completely failed. All of the empirical evidence shows that it does very little to actually stop the flow of illicit funds, and it does a lot of harm. So I think
Yeah.
I think we need to put that mirror up to that system, to those regulators, and say, look, hey, this system's doing a lot of harm. Empirically, it's doing very little to stop what you want it to stop. There's got to be a better way to do this. So that's what I'd say on that issue.
Yeah, definitely room for improvement. I want to ask you guys one other question as we get close to wrapping up. I'm sure, and I know you can continue to do so, but you have been speaking with a lot of different types of potential customers, whether they're retail individuals or different types of institutions. So when we think about the demand side of the equation, and I know, Luke, you've spoken with a lot of these different potential buyers as well. Would love to get your guys' take on the types of potential consumers that you guys are talking to or are interested in talking to, and then generally the kind of feedback that you guys have been receiving in terms of what resonates with people, what do you think really works, what needs to be improved. Would love to get your take, because you guys are in it, right, talking to different customers, I'm sure, every day. Would love to hear your perspective on that.
Yeah, I'd say it's like a lot of crypto native high net worth individuals, and also, just kind of going back to my point earlier of the phase one of this sector being to close the yield gap. It's also a lot of like DeFi protocols, like stablecoin issuers, like those types of almost like like DAOs and technology providers that can benefit from integrating a yield bearing service. I think another sector could be like wallets. That want to have like a click here to like click here to earn 5% interest kind of experience for their users. Exchanges. I think those are kind of the key players in like the early days of the space here. There's I guess I would lump high net worth individuals to some capacity and more of like a retail investor bucket, as well as they like manually going through your app and clicking the buttons and such. But yeah, curious to hear from the other guys as well.
This is Roger again. Well, we have found a variety of customers. As I mentioned before, it's not been our business model to kind of be a direct consumer experience, although in this case, obviously, you can do that, as I mentioned before. But where we've actually seen some adoption is very similar. You have to be comfortable with the digital wallet, system, and holding assets in a digital wallet. And if you're already there in that environment, there's no doubt that the gyrations that have occurred just in base cryptocurrencies over the past couple of years, financial managers of projects, whether they're kind of startups that are in this space, or whether they're DAOs, whether they're anybody that have a large cache of digital assets, they fully understand as they upgrade their financial management to deploy into not just bank accounts, but also into fully collateralized vehicles like a money market fund. Makes a lot of sense to them. They can't keep their bank account in a digital wallet, so they certainly can do that in the case of holding Benji. But that's where we've seen more adoption. I think the other you talked about customers. We probably spend about a third of our time talking with regulators at this part of the market development and these infrastructure developments. And I think we have a benefit of Franklin Templeton of being a global asset manager. So for lots of decades, we've touched a lot of global regulators, and there's just really super exciting adoption rates in a lot of locations outside of the U.S. where the regulators are encouraging this experimentation. There's sandboxes, that we work alongside of companies and other platforms in these environments that they're hoping to bring these constructs to their, quite frankly, to their marketplaces much sooner versus later. And so it's not just customers we're in a lot of dialogue with. It's actually the regulators who are helping lay down the rules for which we hope to be able to propagate these opportunities.
Yeah. I'll guess I'll close and say, yeah, we're seeing the most demand from exchanges, fintechs, digital wallets, custodians, neobanks, who want a way to offer their customers safe and compliant investment products in a way that they can stay entirely on chain. And that's, been an eye opener for us. It's not about the technology; it's about the use case. How can I deliver compliant yield via an API or via an on-chain smart contract, and do it in a way that protects the investor at the end of the day? Seeing a huge amount of demand from those players. And then to Roger's point about the regulatory environment, I'm sitting here in London. Opentrade's a UK limited company. The government here is telling us, keep doing what you're doing, keep building. Like, we want you to stay here. We want to foster this environment. We want to bring investors here to fund your companies. Andreessen Horowitz just moved their crypto team here to London, just opened their first international office. The UK's finance minister gave a speech at that event, right? They're behind it. And so I think, contrary to some of what we've seen in the US, places like London are helping companies like us, as opposed to trying to shut us down. And it's been a very nice, it's been a great thing.
Yeah, I would just echo everything that these guys were saying, and add like one or two quick points. You really do obviously have to start with the crypto natives for these kinds of products. As Roger was saying, the sort of barrier to entry that the wallet experience of participating on chain to date has sort of presented has really held back, I think, the space more broadly. And I think to the extent that we can really improve that experience, it will, serve us all very well going forward. And I really liked how Scott kind of presented the timing around this discrepancy and disparity in yields between what was previously available on chain, right? So if you think about that in the context of higher interest rates throughout this year and lower on chain yields, you have a real, illumination of why crypto natives are hungry for these products. And it's interesting in the context of like one sort of persona that I didn't really realize would have appetite for these products was your market makers or your high frequency, on-chain quant funds or crypto native quant funds who are doing a lot of this like cross exchange arb or, making markets, doing delta neutral strategies. And it's interesting to think about. It's been, up until recently, somewhat of a sleepy market this year in 2023. And at that same time, you've had, a nice yield available via these short duration, government bond funds or products. So that's been like another persona that's been interesting. And previously, those would be the borrowers on chain, right? So you can actually see that, ticking up as rates get higher and higher, the cost of capital gets more expensive on chain with the Aave and the compounds, Maples, etc., whether it's over collateralized or under collateralized. As you see those rates picking up, you can sort of measure and say, okay, it must be like more productive for market makers to be, utilizing their capital to actually trade versus just parking it in these sort of TradFi yields. I think that's been an interesting thing to watch as well.
Yeah, I agree with you, Luke. Cool. Well, I think we're running up on time now, but really appreciate Roger, Dave, Scott, Luke, all of you guys for joining. Maybe let me just ask any kind of closing remarks, closing thoughts before we sign off.
Just a quick plug to, of course, give me a follow at Benny_options and HighYield_XYZ. And we're looking to launch an Avalanche coming soon before the end of the year for sure.
Heard here first.
That's great. Yeah, I'm gonna give Avalanche, the Avalanche team and Morgan, I'm gonna give you guys a plug. Thanks for putting this together. You guys have been a real driving force behind the real world assets, not only as a technology provider, but as thought leaders. So thanks for having us on. And yeah, we hope to be back soon.
Franklin Templeton does the same thing. Shout out to Avalanche and the team for the great integration that we've already done. And we look forward to being able to supply these really important feature sets to the Avalanche community, for the years to come.
Awesome. Thank you guys all for joining. Really appreciate it. Thank you to the broader community also for dialing in. I'm sure, Kyle, we will post this recording shortly, and stay tuned for the next episode of Money Moves.
Yeah. Thanks Morgan.
Guys.
Thanks, Luke. Thanks for all our special guests here. And we'll be posting this recording up on YouTube probably top of next week. So have a great rest of your day and night, everybody, and we'll see you soon.
Take care, folks. Thank you.